Silver will be along for the ride, and you're exactly right. It tends to lag and then it shoots up. But in a recession, silver is going to lag or even go down a little bit because of reduced industrial demand. So it's harder to analyze because you have to balance one against the other. On balance, the way I think about it is subject to timing differences. If gold performs the way I expect, silver is along for the ride. So you'll get to $40 silver, and sooner than later you'll get to put it this way: the world of $10,000 gold is the world of $100 silver.
In today's news recap, silver price drops to nearly 2-month low, 100-day SMA breakdown in play. Silver attracts some follow-through selling during the Asian session on Thursday and drops to its lowest level since September 19th in the last hour. Bearish traders now await a sustained break below the $30 psychological mark before positioning for an extension of the recent sharp retracement slide from a 12-year peak touched last month. The overnight closed below the 50% Fibonacci retracement level of the August-October rally, and a subsequent break through the 100-day simple moving average for the first time since September could be seen as a fresh trigger for bearish traders. Moreover, oscillators on the daily chart have been gaining negative traction and are still away from being in the oversold zone. This, in turn, suggests that the path of least resistance for silver price remains to the downside and supports prospects for a further depreciating move. The white metal might then accelerate the fall towards the 61.8% FIBO level around the $29.65 to $29.60 region. The downward trajectory could extend further towards the $29.20 to 25 cents area before eventually breaking below the $29 mark and tests a technically significant 200-day SMA currently pegged near the $28.65 zone. On the flip side, any meaningful recovery attempt might now confront a stiff barrier near the $30.60 region. Some follow-through strength, however, could trigger a short covering rally and allow for silver to reclaim the $31 mark, though the momentum is more likely to remain capped near the 31.20 support turned resistance. The latter should act as a key pivotal point, which, if cleared decisively, will suggest that the commodity has formed a near-term bottom and pave the way for additional gains. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hit the like button, and send a super thanks if you find our daily recaps valuable. Enjoy the episode.
I said gold could go to $10,000 an ounce, and recently I revised that upward to you do the math, you can update it, but kind of $23,000, $25,000 an ounce. I should explain what that is. It's not well, it will get there, but it's not a hard forecast like, buy gold because it's going to $10,000 an ounce. Instead, it's an expression of it answers a question. The question is, what would the dollar price of gold have to be in order to have the dollar backed by gold? In other words, whether you want a hard gold standard or soft gold standard or any kind of gold reference, why are we not in that system? And what would the price of gold have to be in order to be in that system? And the math is fairly simple. We can do calculus, but this is kind of 7th grade math, or at least where I went to school. So basically, take the money supply, and right away you run into problems. Everyone thinks they know what money is. Well, no, the Fed doesn't know what money is. They have M0, M1, M2. They have all. Whenever you see 5 different measures of money supply, it tells you right away that the Fed doesn't even know what money is. But anyway, I use M1. M0 is base money. That's the money the Fed prints, but it doesn't mean very much because they print it by buying securities from dealers, and the dealer sends in the 10-year notes or 5-year notes, and the Fed pays for the securities with cash. And that money does come out of thin air. That's not just a metaphor. It does come out of thin air, and they pay the banks. The question is, what do the banks do with it? They give it back to the Fed in the form of excess reserves. So all you're really doing, you're expanding both sides of the balance sheet. You're piling on Treasury securities, and you're piling up liabilities in the form of excess reserves. but that money is sterilized. It's not doing anything. No one's getting to spend it, and there's no velocity. The money that does matter, the money that does drive the economy, doesn't come from the Federal Reserve. It comes from the commercial banks, and that's M1. It includes bank deposits and so forth. So I use M1, and then we know the amount of gold the government has, 8,133 metric tons. People go, it's all in Fort Knox. Actually, it's not. About half of it's, a little less than half is in Fort Knox. The rest is at West Point. There's a vault there. Can't disclose the location, but it's there. And people ask me all the time, say, "Hey Jim, who owns the gold? Is it the Treasury or the Fed?" And I say it's the Army, because they're both Army bases. I mean, West Point and Fort Knox are both. I mean, the legal answer is the Treasury owns it, but it's stored in Army bases. So M2, I don't know the number off the top, or M1, sorry, I don't know the number off the top of my head. You can just go to the Fed website. And 8,133 metric tons, break it down by ounces, divide one by the other, and you, one more assumption. How much gold backing do you want? Now, the hard shell Austrians will say 100%, if it's not, it's leverage, or, it's not a solid standard. Historically, that's not true. The Great Britain, backed up by the Royal Navy, ran a very successful gold standard in the 19th century. They had about 20% backing. At any given time, the Bank of England had about 20% backing for their notes. The United States used 40% backing until around the end of World War II, and then they went to 25%. And they ended up at zero by the late 1960s. But it was either 40% or 25%. So take your pick. And the British were about 20%. That's what you need to instill confidence. So my math is take M1, take 40% of M1. That's the dollar amount of gold you need to have a strong gold standard. Divide it by the number of ounces in 8,133 metric tons, and you get a number. And that number today is around $23,000. So, but it keeps going up, and the reason it keeps going up is that the gold supply is constant and the money supply keeps going up. So again, fifth grade math, you're going to get a larger and larger number of dollars per ounce in order to back up a higher dollar amount with the same amount of ounces. So it's about $23,000. So just to be clear, that's not saying that gold is going straight to $23,000 an ounce. That's saying if confidence in the dollar were undermined and you had to resort to gold to restore confidence, you can't just pick a number. If the number's too low, it's going to be highly deflationary, which is what happened in the late 1920s. So what would the number be? And the answer is around $23,000 an ounce.
On the technical analysis side, silver price shows negative trades to move away and support the chances of continuing the expected bearish trend on the intraday basis. And the way is open to achieve the next target at $30.63, which represents 50% Fibonacci correction level for the rise from $26.41 to $34.85. Thus, breaking it will push the price to suffer additional losses that reach $29.64. Holding below $31.63 represents the first protection factor to the suggested negative scenario, as breaching it will lead the price to achieve intraday gains and test $32.86 before any new attempt to decline. Let's get back into the episode.
Analyzing gold, not so much from, I do invest in gold mines. I've been in gold mines and know a lot about the production side of the business, but my main interest has always been gold as a monetary asset. The truth is, gold's not good for much except money. I think it's the best form of money. But you say, well, what else can you use gold for? Well, jewelry. Well, okay, jewelry is just a form of wealth that you wear. You see an Indian bride draped in gold chains. It's beautiful looking. Yeah, but that's her dowry. That's her down payment on the house. That's the kid's college education. So jewelry is just a different way to store bullion. But so gold is not good for much except money. Silver is different. Silver is a precious metal. It can be a form of money, has been, and still is, but it has a lot of industrial input. So when it's an industrial input. So when you're analyzing silver, you've got the precious metals analysis on the one hand, but you have industrial input on the other. And that makes it tricky because if you're in a recession, let's say the price of gold is going up, silver will tag along. Silver will be along for the ride. And you're exactly right. It tends to lag and then it shoots up. But in a recession, silver is going to lag or even go down a little bit because of reduced industrial demand. So it's harder to analyze because you have to balance one against the other. On balance, the way I think about it is subject to timing differences. If gold performs the way I expect, silver is along for the ride. So you'll get to $40 silver, and sooner than later you'll get to put it this way: the world of $10,000 gold is the world of $100 silver. A sliding scale that kicks in fairly early, where you throttle the sell orders as the market's going down. So make up numbers, maybe down 5%. You say, okay, so from now on, when a sell order comes in, we're only going to execute half. The order, the order, it could be in the queue. You can come back later, but we're only going to execute half that order. If it's down another 5%, we're only going to execute 20%. If it's down another 5%, we're only going to execute, 10% or less. And you may get to a point where you close the markets, with, as we do under the circuit breaker system. But instead of going from full liquidity market crash to boom, slam on the brakes, you'll dial it down, throttle the sell orders, slow it down, give people a chance to think, give public officials a chance to, offer some reassurance, et cetera. That's a better system than slamming on the brakes, which is what we have with circuit breakers. But the other thing I do is I offer investors suggestions for part of their portfolio, not all of it by any means, but have a slice of precious metals, have some silver, some gold, fine art, land, natural resources, alternative investments, etc. Have a set of assets that are, first of all, hard assets, meaning non-digital. I'm not saying all silver and gold for sure, but have these other things as well. But the point is non-digital assets that are not going to be frozen or seized or caught up in the kind of collapse or vulnerable to the power grid outage. I have all these Bitcoin people. I'm like, how does that work when the power's out? That's a separate conversation. We can take that to the bar. But the point being, it will protect you against the kind of scenario I'm describing. So again, diversify your portfolio in a way that makes you less vulnerable. And for the regulators, think about a cybernetic approach that could be less of a blunt instrument than slamming on the brakes. And that may be the best we can do. But the real best we can do is to understand the danger. Like I say, I'm not saying get out of the stock market. I'm saying I'm warning people. These are landmines that you need to be aware of.
And there you have it. Jim Rickards is calling for silver to hit $100 and gold to reach an incredible $10,000. What do you think? Could we really see these kinds of prices? Drop your thoughts in the comments below and let's get the conversation going. Don't forget to like and subscribe if you want more updates on what's next for precious metals and the economy. Thanks for watching. Now check this video right here because it's a perfect fit for you. I'll see you on the other side.